Hey everybody, James Akers here. I'm going to talk about a topic that I get asked a lot, and I'm going to try to break it into simple terms, which is, what are the differences in life insurance? There's term, there's whole, there's universal, there's all these different types of life insurance. What is the real difference? So we're going to tackle that today, and I'm going to try to do it in a way that's very easy to understand. And here it goes. We're going to start with term insurance because that's usually what we get asked about the most. What is term insurance? Well, term insurance by definition is life insurance that has a term, which is why it's called term insurance. We compare it to renting a house. You have a lease on a house, for example. You rent it for X amount of time. After that, you either have to renew your lease or it's over with. That's how term works. The most common term insurances are 10 and 20 years. There are 5 years, there's 15, there's 30 years, all kinds of different ones out there, but the most common are 10 and 20. So we're going to use the 10 year as an example. If you have a 10-year term policy and you're 40 years old, then when you're 50, the quote-unquote term is over, the 10 years is up. Now at that point, you'll usually have the option to renew that policy at a higher rate or let the policy just go. And what I mean by higher rate is if you bought it when you were 40 and you want to renew it when you're 50, then you have to pay the premium for a 50-year-old instead of a 40-year-old. Now, most term policies, that happens every year. So at 51, you would pay a higher rate, 52 a higher rate. There are a lot of them out there, though, that it's in what we call bands, excuse me, which would be 5 years or 10 years. So for example, let's say you get it at $50 a month when you're 40, and when you're 50, it goes up, say, $200 a month. And then maybe at 55 goes up to $300 a month. You know, it can work that way, but some of them literally every single year the premium goes up. So term insurance is good for people that, well, I'm really talking about the differences, but I'm going to tell you a good use of each of them really quickly as well. Term insurance is good for people that are trying to cover their salary during their working years. That's, in my professional opinion, one of the only good uses for term. And I'm not anti-term. I have term on myself. I like term insurance. You just have to understand what its purpose is. So if you're 40 years old and you plan on retiring at 65 and your family counts on your income that your salary brings in, then for the next 25 years, term insurance is not a bad option for you to cover your salary. As long as you have a good retirement plan in force, you know, to take care of you after that term expires. Because it's a heck of a lot more expensive to buy life insurance at 65 than it is to buy life insurance at 40. Big difference, okay? Now the other fact about term insurance a lot of people don't realize, and it's kind of like the hidden truth inside the insurance industry, and I'm going to let you in on a secret that a lot of people know, is depending on the study you look at, less than 2% of term life insurance policies ever pay a death benefit. Now, according to Penn State University, it's actually less than 1%. So somewhere between 0 and 2% of term life insurance policies pay a death benefit. So that means somewhere between 98 and 99% of term life insurance policies never pay a death benefit. Life insurance companies love to sell you term because it's basically free money for them. 98 to 99% of every single term policy that they sell to the public is never going to pay. They know that. That's why they're so cheap. Term is definitely the cheapest life insurance for that reason alone. So if you have 100 people that buy term life, only 1 or 2 of those is going to pass away during the term of that policy. There's 2 reasons for it. Number 1, a lot of people just let the term lapse. They just stop paying their life insurance premium, so it's over with, doesn't pay a death benefit. And the second, the most common, is the majority of people, over 98% of them, outlive their term. And when you outlive your term and you look at the premium increase, a lot of times like, no, I'm not going to do that, so they end up buying some sort of a permanent life insurance policy. So that's term insurance. Hope that makes sense on the term. Let's move to the next one, which is whole life. Very common life insurance. Whole life means it's good for your, guess what? Whole life. Exactly. It's good for your whole life. So let's say you at 40 years old, you buy a whole life policy, it's $50 a month. I'm going to use that as our little scenario here. You pay $50 a month at 40. Well, when you're 50, it's still $50 a month. When you're 90 years old, it's still $50 a month. Whole life, by definition, the premium never goes up. and the policy builds cash value, which is kind of like a small investment pool, and it has some guarantees built into it. So the policy is designed to grow over time, but the premium is designed to stay flat forever. Now, whole life is a lot more expensive than term life for a few different reasons. Number one, because it's guaranteed to stay until the day you die. Whereas the term, like I told you, 99% of them never pay anything. So the insurance company is more at risk to pay a death benefit on whole life than they are on term life. 98 to 99% more at risk on whole life. The other thing is it's designed to keep the premium level. So what they have to do is the actuaries, those are the number crunchers that design these, they have to figure, okay, what is the cost of insurance, or the COI? You'll hear that acronym a lot. COI it stands for cost of insurance. What is the cost of insurance for a 40-year-old for this policy? What is the cost of insurance or COI for an 80-year-old for this policy, or a 90-year-old for this policy? And they average all that out to come up with an actual cost of insurance for the life of that policy. And then they factor in the investment side and the cash value side and those type of things. And that's how the actuaries create premium for whole life. So it's definitely a lot more expensive today, but it's not a bad alternative because you're guaranteed to keep it forever. You know, big difference in premiums, but you can keep it for the rest of your life. That's how whole life works. Now, just to break that down a little bit more, there's different types of whole life. One of the most popular whole lives that my agency sells is called a 10-pay. And it's through a really good mutual company that I work with. And that 10-pay, it means if you're 40 and you buy it, you pay on it for 10 years, and then you stop paying, but the policy stays in force for the rest of your life. That's called a 10-pay. Very popular policy. A lot more expensive than a life pay whole life because you're paying up to 10 years. But it's designed to make sure that you don't have to keep paying for insurance for the rest of your life. Really good for people that have some extra money that want to put into it. Matter of fact, I use those a lot for tax-free retirement planning. You know, you give me a 30 or 40-year-old, I put them in a 10-pay whole life that's overfunded through a mutual company, and that policy can grow and grow and grow and grow and grow. When they retire, they've got a whole lot of cash value they can pull out. So there's also 7-pay versions, there's 20-pay, there's different breakdowns of the same concept. That's whole life. Lastly, I'm going to talk a little bit about universal life. Again, try to make this as simple as I can, then we'll give you a summary in just a minute. Universal life came out of the era where a lot of investors said, don't buy whole life, buy term and invest the rest. And they were saying to buy the cheaper term life insurance instead of buying the more expensive whole life. Take the difference in those premiums and put it into the stock market was what they were advising. And so out of that, a product called universal life was born. Excuse me. Basically what universal life insurance is, to make it simple, it's pretty much term insurance with an investment pool. So they figure out what would the term insurance cost, or the cost of insurance for the term be for the life of that policy. And most universal lives are guaranteed to age 80. Some of them are guaranteed to 90 or 100. If you buy universal life, make sure it's guaranteed until you're going to pass away. That's very important. Otherwise, you could end up with no insurance. But universal life, they figure out what's the cost of insurance for the term, if you want term insurance. And then they figure out, okay, how much cash value do we need to build to cover the increasing cost of insurance? Give you an example. Let's go back to the first term example. If you're paying $50 a month at 40 and the cost of insurance goes up to $200 a month at 50, just to use that as an example, then the universal life policy would need to build enough cash value during that 10 years to offset the extra $150 a month in premium. That's how universal life is designed. So what happens is you're pretty much overpaying for a term life. When you have universal life, you're pretty much overpaying for a term life policy for the first 10, 15, 20 years. You're overpaying. That overpayment is going into an investment pool that hopefully is growing. You know, they're usually indexed with the Standard & Poor's or something like that. Hopefully it's growing, and as it grows, that cash value is going to be used to offset the increasing cost of insurance of that policy over the years. That's why you need one that's guaranteed till you're at least 80 or 90 or whatever, because if you don't have one that's guaranteed and the investment pool doesn't do well, goes down, your cost of insurance goes up, you end up in a situation where the universal life policy can just lapse because there's not enough cash value left to pay the premiums on it. Okay? Now, Different types of universal life. There's indexed universal life, there's guaranteed universal life, there's variable universal life, there's all kinds of different, I'll break that down in a different video at some point, but to give you the brief of it, if you're buying universal life, which by the way I'm a big fan of, I have universal life, love universal life, I think it's a great option as long as it's designed to guarantee you until you're going to die that you're going to have insurance. The worst thing you could do is be paying, say, $200 a month for a life insurance policy that you think is going to be around till you die. And then you pass away at 85 years old, and your beneficiary finds out there's no insurance. The policy's lapsed. I've seen it happen numerous times. I've had calls, just in the last year, I've had 3 calls from people that have had universal life for 20 years or more, and they found out that they got a letter from the insurance company saying, hey, you owe us X amount of dollars to keep your policy in force. And they freaked out. Now, I didn't sell those policies. Let me be clear about that. They just reached out to me because they knew I'm an expert in this to see if I could fix it. And I had to basically sell them new life insurance because their cost of insurance had risen and their investment pool had decreased, and the two just kind of didn't work out the way they wanted to work out. So be very careful. If you work with an insurance broker or an insurance agent that wants to sell you universal, but they don't guarantee you that it's going to last until a certain age, walk away from the table, call somebody that cares enough to do that. Make sure there's some guarantees written into the contract. And here's what that means in brief, then we'll summarize the whole thing. If I was to sell you an indexed universal life policy guaranteed to age 100, for example, that means no matter what happens with the investment pool, the insurance carrier is contractually and legally obligated to pay a death benefit to your beneficiary until you reach 100 years old, regardless of what happens in the markets. That's how one of those guaranteed universal lives works, and that's what I'm a fan of if we're using it as a death benefit. So lastly, before going to a summary, a lot of times we use life insurance because it has a lot of tax loopholes to help people plan their retirements. Now, if you're just using your life insurance to plan your retirement, we're not worried about guaranteed death benefits. We're worried about how much cash can we build. That's a topic for a completely different day or for a one-on-one conversation, which I'd be happy to have with you. So just to summarize everything, 3 major types of life insurance: term, whole, universal. Term life rarely pays a death benefit because most people outlive their term, but it's cheap. It's great for if you're in your working years and if you passed away, you want to replace your salary for your family. Great option for term insurance. Or maybe to cover your mortgage or your car, something like that. Great for term. Whole life, what am I saying on term? If you buy term, make sure it's convertible term. What I mean by that, I'm sorry to go a little bit longer here. What I mean by that is if it's convertible, that means even if your health declines, you can convert that term insurance into a permanent insurance, either universal or whole life. That's very important. Make sure your term is convertible. Do not, I repeat, do not ever buy term insurance, term life insurance, that isn't convertible to permanent insurance. Crucial. Give you a quick example, just so you understand what I'm saying. Had a client that had term life with one of my carriers for a long time. Her agent had either retired or passed away. I don't actually know the details. So the insurance carrier that I did a lot of business with reached out to me and said, hey, this lady needs help. Can you help her? I said, absolutely. I called her up. She lived about 2.5 hours away from me. I called her up, and she had her term life, and it was getting ready to expire. The term was about over. So I went and met with her, actually at Panera Bread in Clarksburg, West Virginia. I'll never forget where we met. I'll never mention the client's name or anything. But met with her, and we looked at it, and when she bought her term insurance, she was in absolute perfect health. She had a preferred rate, and it was really, really cheap. Her health had declined. She had a lot of health issues happen since. So we took advantage of the loophole, the conversion loophole in her policy, and we converted that to a whole life. And now she had insurance for the rest of her life because we were able to convert that even though her health declined. So don't ever buy term life that's not convertible. Okay, that's term. Whole life, same price for the rest of your life, but it's the most expensive of the 3. I am a fan of whole life, especially for the guarantees and everything else. You'll talk to a lot of people who say, don't buy whole life. Whole life's terrible. Well, let me tell you something. The biggest investment companies in the world, including Chase, Warren Buffett, Berkshire Hathaway, a lot of their portfolio is made up of whole life insurance. Look it up. You'll see, fact check me, you'll find out I'm 100% correct. A huge portion of most banks' portfolios are in whole life insurance for one reason and one reason only: the guarantees it gives. Whole life insurance, everything's written in black and white. Yeah, it's more expensive, but everything is guaranteed. So it's not a bad situation. That's why Warren Buffett, one of the greatest investors that's ever lived, that's why he has a lot of whole life. Walt Disney had whole life. J.C. Penney had whole life. A lot of people use that to help offset the risks of their stock portfolios. Lastly, universal life, it's kind of in between the two. It's a hybrid policy. It's going to be more expensive than term. It's going to be cheaper than whole, but you can have guarantees built into it, so it's going to last you the rest of your life. Guys, I know this was just a kind of a brief summary. I hope it gave you a little bit of education. To answer the question I get asked all the time is, what is the difference between term and whole and universal life? I hope I've answered that question for you today. If you have questions, just reach out to my office. We'll be happy to assist in any way we possibly can. But I hope you have a wonderful day, and God bless you.